So hi, Nate. Every time I say your name wrong, this is because I'm French. Sorry.
It's fine. I love it. I love the way you say my name.
So today, what I would like to do is really to ask you a couple of questions. So the first one will be to introduce you to the audience and tell us a bit more about yourself. Yeah?
All right, lovely. So thanks, Vanessa, for this opportunity for me to talk to you. My name is Nade. I am a chartered financial planner. So what that means is I'm able to offer regulated financial advice in all aspects of financial planning. So savings, investments, retirement, inheritance tax, everything. So that's me professionally. I've got my own partner practice now under the corporate structure of St James's Place Wealth Management. But my background has always been bank assurance. So I've been providing regulated financial advice for more than 20 years now. So I've got lots of experience. I'm charter qualified, so I'm well qualified. So I'm able to look after my clients in the way, best way possible for them.
Thank you for that. Okay, so what I would like to talk about today is investment. So can you probably tell us, first of all, what's investment for you? What's your definition of investment?
Okay, so you've got savings and you've got investing. So the difference for me between the two is when you're saving your money, that money usually will be within a cash or deposit environment. So savings are when you put your money in a deposit account in a bank and you will earn interest on that money. So it will stay there, so your cash is there. So if you put in £100, even if you go back after 5 years or 10 years, your £100 will be there. And hopefully it's gone up a little bit because you've earned some interest on that money. So that is your savings. Investing is when you're looking at putting the money somewhere other than that environment. So it won't be cash and it won't be deposit. It will mainly be made up of other asset classes. Might be a single asset class. So when I say asset class, it can be things like shares in companies. It could be made up of property. For some people, it might be gold, so it's somewhere else other than that cash deposit environment where you invest your money in order for it to work harder and give you more opportunity and more potential for growth. So that for me is a difference. I don't know if that makes sense.
Yeah, it makes totally sense. Yeah. Okay, so the next question really is, if we aim to become an investor, what will be the big mistakes we should avoid?
That's a tricky question. So I think when we talk about investing, I think now's probably a good time for me to mention the word risk. So risk means different things to different people. And I think it's worth noting that risk is inherent in whatever you do. So whether you're saving or whether you're investing, you will be exposed to risk. But obviously there's different levels of risk. So if we start with savings, so when you leave your money in your bank account, in your deposit account, the capital is secure. So your capital is safe. The risk that you're exposed to is that over a period of time, if the interest that you're earning on those savings isn't really keeping up with the cost of living, with prices, with inflation, the cost of goods, then actually in real terms, the buying power of that cash is being eroded. So in a way, it's like a hidden risk. You don't really see it because your capital amount will remain the same, but actually over a period of time, the purchasing power of that money in that account will be depreciated over time. So that's something that most people aren't really aware of, or they don't really notice because you can't see it. Now, when you're investing, what happens is, depending on where you invest or how you invest, it's likely that the capital that you put in will go up and down. It will fluctuate in value. And the extreme point of that is that you could lose capital value depending on where you choose to invest. So an example of that could be, for example, like cryptocurrency. It's very popular at the moment. People very quickly can make lots of money, but likewise, very quickly, lots of money can be lost. So the actual value of that asset, goes up and down quite quickly. So there's risk there. Another example would be single company stocks. So if you chose to buy shares, for example, in a company, and that company does very well, they might be paying dividends, the share price is going up, so your capital value is increasing, it's producing an income. But similarly, if that company runs into difficulty, in a worst case scenario, they go bankrupt, it could be that you can lose all the money that you've invested in that particular stock, or certainly, there might be a significant drop in value and the capital that you've invested could fall quite dramatically. So mistakes that you might make when you're investing, I think, is maybe understanding the risk of, the investment that you're going into, actually being aware of what that means and how that would impact on your own personal financial circumstances. Because attitude to risk is one thing. Somebody might have a very high attitude to risk, very high, and they might be prepared to, be quite speculative even, to try and work that money harder. But the other thing to be aware of is something that we call capacity for loss. So can you absorb that loss? What else have you got? So if, say, you've invested in a particular stock, that stock has, taken a bit of a nosedive, was that everything that you have that you've invested in that particular investment? Or have you got other things that you can rely on while that's going through whatever it's going through at that moment in time? Or can you afford to absorb that loss if you have to write it off altogether?
Yeah, that's quite interesting, really. The how you see things, how you actually see the whole picture, and what's your aversion of risk, and what risk you willing to take in exchange of the rewards. Exactly. Yeah, that's quite interesting, really.
Yeah, exactly. It always comes down to that relationship of risk versus reward. How much risk are you prepared to accept in return for how much reward? So that's quite a deep conversation to have, actually. And also, different people have different experiences as well. That own maybe personal experiences or experiences that they've heard of, and all of that can affect how you feel about something.
Yeah, definitely. So I think for now, I'm gonna share with you some quotes I really liked about the book from Rich Dad, Poor Dad, The Cash Flow Quadrant, and then we can reflect on that, yeah?
Okay.
My poor dad often said, investing is risky. My rich dad often said, being financially uneducated is risky.
Mm-hmm.
Can you share any thoughts on that?
Yeah, definitely. Yeah. So I guess it follows on from the conversation that we've just had, isn't it? When we talk about mistakes that beginners can make when you start investing. So, being financially uneducated is risky in the sense that if you're going to make financial decisions without maybe doing, your kind of governance and due diligence and research and reading and have a bit of understanding, then it makes it that much more riskier for you because you're kind of going into something blind. And in that instance, then investing is risky, because you're going to be putting your money somewhere where you really have got no real idea of the returns or the risks that you're exposing yourself to. So I think that's good. It's like two sides of the same coin, isn't it?
Yeah. Financial intelligence determines not so much how much money you make, but how much money you keep, how hard that money works for you, and how many generations you can keep it.
Yeah, 100%. 100%. And I think what this is coming back to, and in my own experience, sometimes I see it, is the more you're earning, the more you're spending. So it's like you live to your means. You know, it doesn't matter if you're earning, 10,000 or whether you're earning 100,000. You know, often financially you're in a very similar position with actually how much money is left over at the end of the month. You know, so I think this is something that's really critical, to have that understanding, to think, okay, I've got, have a real control of your numbers, like we talk about it, like know what's coming in, know what's going out, and be in a position where you're able to, not be spending everything that's coming in, and being able to hold on to, some of that money. And then, the first place to be able to build up your cash reserve, build up your cash cushion, make sure you've got an emergency fund, so that you've got a bit of money to fall back on in case anything unexpected happens. And then outside of that, look to invest money. So look to put money somewhere where it can work a bit harder for you. Because ultimately we work hard, don't we? We're working hard for our money. So, we should be thinking to be putting something to aside so that it can work a bit harder for us. And also the bit here where it says, how many generations you can keep it, because many people, they'll focus on like themselves, like now, and have a lot of wealth, can be considered very wealthy, might have lots of property, lots of different assets, but actually when it's going to be handed down to the next generation, what they've maybe not thought about or not planned for is the amount of tax that's to be paid before it goes to the next generation, like planning, like legacy planning, and actually thinking about your wealth, not just for your generation, but for future generations. So yeah,
wow. That's awesome. I have the impression we already learn a lot by saying that. Thank you. The next one is, a big secret is that true investors make more money in bad markets. Are you agree with that?
Yeah, 100%. So with markets, and here we could be referring to any market, I'll give reference to the stock market. Often that's the market that we tend to read about the most or hear about the most. When it might be going through a period of volatility, stock markets have gone down, so many million of pounds been wiped off, the companies. And really, we would have all experienced that with the pandemic, that we're all living through at the moment. The impact on the stock market literally overnight was very dramatic, big falls like globally. So I think what I find myself personally, and it is a conversation that I have with my clients, in that moment, is to actually not panic. I know it's easy to say, but if you have invested money, you would have invested it for a reason, you would have invested it for a period of time, you would have had a goal or objective in mind. That probably still hasn't changed. That probably still is the same. So in that moment, the right thing to do is just to hold tight, hold fire, not make any kind of rash decisions. But when markets take a bit of a downturn, it actually is a really good time to invest. It's actually a brilliant investing opportunity if you have got money, that you're prepared to set aside and you can leave for a period of time. So not being speculative, because again, when we talk about risk, that's a risky strategy. If it's money that you need, for your mortgage the next month, and you're going to put it into the stock market in the hope that you're going to, make loads of money overnight. I'm not talking about that. I mean, if you've got some money sitting in a deposit account, outside of that contingency cash reserve, not really working for you. And actually, if you've got a longer term goal or objective, maybe it's for children's education, maybe it's for your own retirement, maybe it's for business or property goals in the future, money that you can afford to set aside, actually investing when markets are on a bit of a downturn is perfect, because you get more for your money. Like with any asset class, any investment, you don't want to buy at the peak of the cycle. You actually want to buy when the market is down. Like property, if somebody wants to buy a property, they don't want to buy property when prices are high. They want to hope that there's a bit of a crash and they can get in and buy the property, when the markets are down. It's exactly the same with any market.
Yeah, I think there was another quote inside this book saying that it doesn't matter how much you sell. What's really important is how much you buy.
Yeah. Good.
Okay, and then I think that's the last one. Instead of avoiding risk, I recommend learning how to manage financial risk. And it's definitely in line with financial education and what we discussed early on. if you would like to add something.
Yeah, I would hit. I mean, one of the cornerstones, I think, of kind of good financial planning is diversification. You know, like have a nice diversified portfolio, have a nice broad mix of different assets. So when you're looking to investing, you know, don't like limit yourself and maybe only have one asset class, because, you know, again, if you think about a risk point of view, that's quite high risk, because effectively all your eggs are in one basket, right? So when we're talking about managing financial risk, a really effective way to do that is to have a diversified portfolio of assets, have a nice broad mix of, you know, different markets and different asset classes. Because what tends to happen is, you know, a lot of these things tend to be cyclical, so they don't all go up and down at the same time. So if you've got a nice broad mix and a nice broad spread, you benefit from that. You're actually diluting the risk. The more that you diversify your assets and the more of a diversified portfolio that you have, the more you're diluting the risk that you're exposing yourself to.
Perfect. I love it. Thank you, Nate.
You're welcome.
Maybe in 3 bullet points, what should we bear in mind when we actually go into the world of investment?
Okay, so I think a big decision to make is whether you want to go it alone or whether you want to maybe engage a financial planner. You know, and the thing is, it's always worth maybe having meetings and having a conversation, because you're not necessarily under any obligation to do anything. So, you know, it's worth talking to somebody who can give you lots of information and point you in the right direction, and, you know, give you an idea of what you should be reading or what you should be thinking about. So I think that's probably a good starting point if you're completely at the beginning of the road and you're like, oh, right, where do I go? So maybe have a chat with someone like a financial advisor that can probably give you a few ideas. From an advice point of view, I think, you know, having a contingency fund, you know, emergency cash fund definitely is essential. Before you look to do any sort of investing, I would advise that you have a reasonable sized cash buffer, and it can be different for different people because everyone's got their own needs. But usually maybe 3 months worth of outgoings is a good enough, you know, starting point, plus any planned spending you might have. So kind of ring fence that and go, right, that's my cash cushion, I'm going to kind of set that aside. And then when you're actually looking to start to invest, I think make sure you're diversified. So look at a nice broad mix as opposed to maybe single asset classes. I think that reduces the risk for you. I'm going to say a bit more. I'm going to say think about your time horizon as well. So the longer your time horizon, again, that reduces the risk. So if you imagine you've got money and you need that money next year, you're not really going to be able to do much with it because you need it next year. But if you've got money and you're like, actually, I can leave that for 10 years, like maybe it's for my son, you know, for his university, or maybe it's for myself, you know, for my future, then you can do more with that money because you've got that time horizon. So maybe I would say think about your objectives, you know, so rather than just investing for investing's sake, have a think about what you want, you know, what your plans are. Maybe visualize where you see yourself 5 years time, 10 years time, 15 years time, and that hopefully will help a bit as well.
Yeah, I like that. Yeah, brilliant. Thank you very much, Nate, for joining us today. So happy to have you. And yeah, maybe the last thing is to share your details. So where can people contact you?
I'm on LinkedIn. Yeah. I was going to say I'm really poor on all the other social media platforms. I'm not really on anything, but I am on LinkedIn. So Nade Khan on LinkedIn, you should find me.
Yeah, perfect. Thank you.
Thanks, Vanessa. Thank you.
Thank you for having me. I'm Vanessa Belair. I'm your freelance marketer. I do marketing for businesses, and we also run networking events for women. We do training and also business coaching. So if you want to know more about the whole perception the whole thing about FTM Women's Network, we do have a website called ftmwomensnetwork.com, so you can have a look at the website, and talk to you soon. Bye.